In this podcast episode, Raoul Pal explores the transformative impact of artificial intelligence, AI, on the global economy, the evolving dynamics of liquidity and crypto markets, and the geopolitical shifts affecting the US dollar's role as the world's reserve currency. He delves into the challenges and opportunities emerging from these trends, discussing how investors can navigate this uncertain yet promising landscape. The conversation also touches on broader societal and economic themes such as the K-shaped recovery, the future of corporations, and the integration of AI as an economic actor. Raoul Pal positions AI as humanity's greatest discovery, emphasizing the shift from biological intelligence to silicon-based intelligence, which operates millions of times faster. This seismic change results in unprecedented network effects that follow not just Metcalfe's law, but a compounded Reed's law, double exponential growth. AI is absorbing liquidity from other sectors, such as crypto, impacting speculative enthusiasm and causing market dislocations reminiscent of 208. Despite these shocks, Pal argues AI-driven productivity and innovation will redefine economic growth, potentially enabling GDP growth rates of 10 to 20% by 2030 and beyond. The resulting economic singularity will see AI integrated into corporate boards, sovereign wealth fund decisions, and everyday business operations, fundamentally transforming decision-making and resource allocation. Liquidity is central to the evolving economic ecosystem, with Pal stressing the importance of ongoing liquidity support to fuel growth and manage debt obligations. The U.S. government and Federal Reserve have historically supplied liquidity through balance sheet expansion post-2008, but regulatory changes are pushing banks to take on this responsibility. Liquidity growth of around 4% currently falls short of the approximately 8% needed to fully fund debt servicing and interest payments, which constrains speculative flows into riskier assets like crypto. Pal underscores that liquidity is the total supply of dollars in the system, distinct from velocity, which measures how quickly money circulates. The relationship between liquidity, liquidity-sensitive assets, and economic health remains a delicate balance, with any withdrawal potentially triggering sharp corrections. Nonetheless, the expected massive capital expenditure, CapEx, in AI infrastructure through 2030 suggests liquidity demands will escalate, though the banking system may play a more significant role in meeting them. Pal highlights crypto as the most liquidity-sensitive asset class, with Bitcoin's scarcity and the technology underpinning Ethereum and similar networks driving fundamental interest beyond speculation. Stablecoins are rapidly growing, becoming crucial economic tools that facilitate large-scale liquidity movement and could serve as significant buyers of U.S. debt. This evolution integrates crypto into the broader financial system, with banks and institutions beginning to tokenize real-world assets, a process still early but accelerating. Despite temporary setbacks and sideways movement in crypto markets, the technology's adoption curve continues upward, supported by both regulatory acceptance and technological innovation. Speculation dominates current crypto price action, but long-term secular growth is expected due to technology adoption, not just market hype. A theme throughout the discussion is the future of the U.S. dollar as the global reserve currency. Pal acknowledges that every empire and its currency eventually lose the reserve currency status. However, he expresses skepticism about imminent collapse scenarios, highlighting that such narratives have historically generated fear and opportunity costs for investors. While acknowledging that central banks globally, particularly China, are diversifying, accumulating gold, and exploring alternatives, the dollar remains deeply entrenched and indispensable to global economic functioning. The transition away from the dollar, if it occurs, will be gradual and protracted, perhaps over several decades. Arguments for a Bretton Woods 2.0 or a dollar replacement acknowledge existing geopolitical tensions and financial repression, but caution against expecting abrupt changes that unsettle investments. Pal critiques the conventional use of the CAPE ratio as an indicator of market danger, without adjusting for currency debasement, which inflates nominal prices and shifts historical valuation baselines. He observes that since 2008, massive monetary expansion has elevated asset prices relative to earnings, making traditional valuation metrics appear overstretched. However, Pal argues that we are not yet at the extremes of collective market irrationality seen in previous bubbles like the dot-com era. While speculative excess and investor mistakes will produce losers, the long-term secular trend toward technology-driven growth remains intact, justifying disciplined, long-term investment approaches. He advises managing psychological tolerance for volatility by adjusting position sizes and keeping reserves available to accumulate assets during market corrections. Raoul Pal himself experienced psychological scars leading to extended avoidance of equities after prior crashes, but credits long-term holding and buying dips for enduring wealth generation. Pal touches on the ongoing K-shaped economic recovery, where gains concentrate among capital holders and certain sectors while others face stagnation or decline. He foresees worsening sociopolitical tensions stemming from this divide, intensified by demographics, labor versus capital struggles, and the accelerationist versus decelerationist debate over AI adoption. The challenge of balancing debt service, countering inflation, and sustaining livelihoods through currency printing fuels inequality and societal friction. Political polarization and economic shifts reflect these structural changes, with no simple resolution, as attempts to stop currency debasement risk collapsing pension systems and asset values. This complex interplay shapes the context for how economies and societies evolve in coming decades alongside technological upheavals. Highlighting the evolving nature of business entities, Pal questions traditional concepts of companies as human groups acting with legal personhood primarily for profit. He envisions a world where many companies become autonomous or semi-autonomous, AI-driven entities, operating workflows and decision-making with minimal human intervention. Royal Dutch Shell and other large legacy firms exemplify entities whose real value or purpose is obscure in the current form. Pal foresees the stock market and economy accommodating dramatic transformations, where a handful of companies like SpaceX or Amazon capture enormous value, while the majority of existing firms may fail or become obsolete. He interprets this as a reflection of the broader economic singularity, where productivity gains and allocative efficiency reshape business and market structures fundamentally. Pal explains that AI is rapidly becoming an economic actor in its own right, capable of autonomous transactions, task execution, and generating economic value. The rise of AI agents performing jobs, making and managing economic decisions, coupled with growing blockchain and stablecoin infrastructure, gives these agents direct interaction with financial systems. The energy and compute they consume equate to their fuel, creating a need for financial flows analogous to human incomes. This transformation could lead to drastically higher productivity as robots and AI augment or replace shrinking human labor forces due to demographic declines. This generates the possibility of significant GDP expansion driven by synthetic labor without commensurate wage inflation, challenging conventional economic models. Pal points out Amazon as a microcosm of this shift, where robotics and automation have increased output per employee dramatically, which he views as a harbinger for the broader economy. In the near term, Pal agrees that central banks will continue navigating the difficult balance of accommodating debt burdens while supporting innovation-driven growth. Drawing parallels to the Greenspan era's tolerance for inflation during productivity gains, he sees policymakers like Kevin Warsh managing short-term liquidity and rates to sustain economic stability. Debasement of currency remains a strategic choice to reduce real debt loads over time, but must be balanced against inflationary pressures and social consequences. The trajectory points to continued monetary accommodation, while technology matures into a driver that can sustainably outpace debt growth by lifting productivity, especially post-2030. Pal expects that government support and regulated liquidity creation, supplemented by the banking system and capital markets, will underpin the economic expansion catalyzed by AI. Pal encourages a long-term, diversified approach focused on technology, crypto, especially Bitcoin, and stablecoins as foundational pillars. He stresses the importance of psychological preparedness for volatility, avoiding leverage, and maintaining flexibility to buy during corrections. While recognizing risks and inefficiencies in markets, Pal frames the current era as the greatest investment opportunity in human history due to exponential technological growth. He notes that even the largest tech companies hold relatively minimal debt and strong cash flows, enabling them to weather market disruptions and invest heavily in future capacity. Pal highlights that investing in the broad secular trends rather than individual speculative bets mitigates risk and aligns with the overarching narrative of intelligence-driven economic expansion. Throughout the conversation, Pal underscores the unprecedented speed of AI and related technological adoption. Platforms like OpenAI and Anthropic have reached scale faster than any company or technology in history, boasting billions of users within just a few years. This creates challenges for human comprehension and investment strategy, as markets may experience sharp cyclical swings, but the overall momentum remains overwhelmingly positive. Pal compares the current capex boom in data centers and compute infrastructure to the laying of railroads or fiber optics in previous technological revolutions, but notes how much larger and faster this boom is in comparison. He warns of capital misallocation and accidents along the way, but is confident the trajectory towards a more intelligent, automated economy is irreversible. Raoul Pal introduces his universal code thesis, contemplating intelligence as a fundamental cosmic process emerging from coherent networks at all scales, from particles to humans to AI. He suggests that humanity and machines are nodes in a vast ecosystem of intelligence and computation, linked intrinsically and mutually dependent. This conceptual framework supports his optimism that AI will not destroy humanity, but rather amplify collective knowledge and intelligence. He likens AI's rise to a natural evolution akin to ecological interdependence, predicting a future where human and artificial intelligence coexist and co-create within an expanding network of consciousness and capability. Pal highlights how AI platforms are democratizing access to programming and content creation, enabling individuals to build complex applications or automate workflows with simple voice or text commands. He showcases his own use of multiple AI instances simultaneously to manage tasks, writing, and research, illustrating how ordinary people can now harness exponential intelligence to unlock productivity and creativity. This accessibility reduces barriers to entry for technology investment and innovation, favoring those who adapt rapidly and embrace AI tools rather than fearing disruption. Pal is also launching an AI version of himself, trained on his content, to engage users in interactive economic discussions, symbolizing the merging of human expertise and machine intelligence for continuous learning and evolution.